Okay, this is great. I want to thank everybody for coming out to the Applied Value Investing Stock Pitch Challenge. It has a new name this year, and we're going to talk a little bit about that. Before we start, as Meredith is walking away, I want to thank her and the Halbrand Center for sponsoring this program. And more than that, I just want to recognize the fact that the Halbrand Center is an amazing organization. It's very special. The Applied Value Investing Program itself is an incredible opportunity for investors to learn, focus, and understand a disciplined investment process that I can personally attest to can help you create superior excess returns over an entire career. So I think that those of you who attend the AVI program are very fortunate, and we're very glad to be here helping out in any way that we can. A lot of education is teaching people how to do things. In asset management, the things that you learn to do are accounting, the language of money, and research. Learning how to do research is a big part of this program. However, the key thing that you want to learn while you're at school is how to think about complex situations and form the proper judgment that will help you make good investment decisions. It is this exercise of judgment that this event tries to impart through a Socratic process. The judges are very experienced money managers. Let me introduce them. We have James Pan here. James, please raise your hand, from CP&E Partners. We have Jenny Wallace. And James and Jenny this year have helped me sponsor the program. This is Artisan Partners, the firm that I work for. And we have Jeff Hume. We have Paul Sonkin, Jason Leader, and former winner Tyler Red here at the end. This event is for the students to learn, and there is the added benefit of a cash prize. And if you are in the crowd and you're looking for a new employee, you're in the right place, because we have a group of very, very talented individuals sitting in this room. So I want to thank you for your attendance, and now you're in for a real treat. Pleased to introduce Adjunct Professor Paul Johnson. He's an incredibly forward thinker about investing and an amazing MC. So please give a round of applause for Paul Johnson.
You know, the key to investing well is keeping expectations low. So I always like it when Dave says nice things, because then it sets the bar here. You know, I was thinking, I'm a huge fan of this program, huge fan. And I was thinking about, when you ask a fish, how's the water? They sort of say, what's water? And I think when you're at Columbia for 2 years, you have no perspective on how intense and in depth and broad-based your education is when it comes to investing. Because you're in it and you see it, and you're with all your friends, you're going to all these classes, but there are, I don't know, Meredith will correct me, there's got to be sort of 30 potential investing-related courses at Columbia. 40, I mean, and when you go to any other top 10 school, there's like one. And so it's just like, it's not like there are 15 at other schools and we're at 47. There's one at other schools and there's 47 here. So it is unbelievable. And I really want to echo what David said on a couple of things. Number one is the exposure you're getting here is it's beyond world class. It is truly leading edge on all kinds of dimensions. And the fact you can have that exposure, if you're interested, passionate about investing, there is no better place. If you're an employer, you know somebody who's an employer, this is the best crop in the country. So I just want to echo that. I'm going to talk about our judges in a minute, because they're volunteers and they're very busy. They have a lot of demands on their time, and they come back every year. I'm going to talk a little bit about that. We do have 3 sponsors this year, and Jenny looked at my presentation. She said, you have a typo, because you have 6th annual and 1st annual. And then I just do this to make the slides go. And then it's the 15th annual. event. So I'll go back for a second. They're all correct, and it's the sort of one of the values I want to talk about. This is the 6th annual event that David and this group of people have been intimately involved, but the name has changed a couple of times. So it's the first annual Applied Value Investing. We've opened this up to be really sponsored by the AVI program. Before that, it was the Artisan Artisan International Value, but I couldn't find the logo, David, so I went with the main logo. And then this year, Jenny Wallace, who's a graduate, is a sponsor, and James Pan, who's a graduate, are sponsors. I'm going to come back to that theme a couple of times. All right, so here's the past 6 winners. One of these great students will add their name here. I'll talk a little bit about that in a minute. But I really want to talk about is relationships and legacy. And that, to me, is what the important part of this program is. The relationships you're developing and the legacy you're taking on. Because we've all been doing this for a while, but we're getting older. We've recruited Tyler, which is really great. But you're the next generation of the participants, the judges, the mentors of this program. And you're now part of this community, and I think you have a responsibility to continue to be involved. We will be around for a bit longer, but at some point we're going to need the next generation to step up and start taking on some of the responsibilities. And so I'm going to step back to the history, very quick tour of the history, so you can understand, really, move the microphone up. You can really, I never use you can understand the history of this, which to me is just incredible. All right, so it starts in 1927. Ben Graham decides that he actually decided he wanted to write a book on investing. There were no good books back in the 20s, but he thought, you know what, I should go teach a little bit, and then at the end of that, I'll be able to write a book. That was his motivation. Now, if you go back, Ben Graham graduated in 1914. He was the second in his class, and upon graduation, he was offered positions in the philosophy department, the literature department, and the math department. I'm sure you have friends like that. Right? And he got through school in 3 years. So clearly very bright, but incredibly broad capability. He was also offered a scholarship, an entire scholarship to the Columbia Law School. So you were talking about somebody who was very capable. He didn't want to go into academia. He wanted to go make money because his father had been wiped out in the Knickerbocker crash in 1906. So basically his family was somewhat destitute. So he went to Wall Street, first as a bond salesman, hated it. But on the side, he was doing research, and that's what really brought him in. And his original firm let him start a statistician's department, which was the beginning of investment research. He taught at Columbia ultimately until 1956. Along the way, he asked the dean if he could have an assistant professor help him, and there was a young man named David Dodd. And so David Dodd joined him in the classroom to take notes, do some work for him, and assist him. And after a couple of years, they decided to write the book, which became Security Analysis. Which is obviously extremely important, and the beginning, and it started at Columbia, effectively this program 85 years ago. In 1956, Ben retired. He moved to La Jolla, California. Part of his time was spent in France, and there was a guy named Roger Murray who had already come to help the dean with some administrative stuff. He was teaching some corporate finance, and they asked him to take over the class that Ben had taught, and he taught until 1977. He retires in 1977, and the program just runs adrift for 15 years. One of his most important graduates is a guy named Mario Gabelli. He also taught Leon Cooperman and Chuck Royce and a couple others. And Mario in 1993, really in 92, he planned it. He said, we need to get Roger back. I wanted to do kind of a living history, if you will. I want to record him. And Roger Murray, at 85 years old, lived in New Hampshire, came down every Friday, stayed at the Yale Club, walked back and forth, all these things, and he gave 4 lectures for 90 minutes, with each lecture for 90 minutes without notes. Paul Sonkin and I ended up writing a little biography of him, and we put the transcript of those lectures. I didn't realize, I had known Dave and James and Jason for a couple of years, and I'm writing this book, and they just happened to mention they were at the lectures. I was like, wait, what? So they started telling me the stories from back then, which becomes this tapestry. Now, on the 4th lecture, a guy named Bruce Greenwald, who was a young professor, had come down from MIT, was, as he says, dragooned by the dean, Mayor Feldberg, to the lectures, and instantly realized there was something here. And between he and Roger, they came back in the fall of 93 and started teaching a course that became the value investing course, which I think is now called Legends, which is the base of all of that. So I thought that's pretty cool. And this is Bruce's quote, that it just made so much sense that he convinced Roger to come back and teach with him. And the original structure was that Roger taught 2.5 lectures, and then Bruce taught 2.5 lectures, and then they invited guest speakers for the rest of it. And that became a book, which is From Graham to Buffett and Beyond, which Paul Sonkin's a co-author of and has been reissued last year. But that came directly out of the course. What ends up, there's a prehistory that's pretty important. So these were the original speakers: Buffett, Gabelli, Chuck Royce, Seth Klarman, Michael Price, Robert Bruce. Jenny ended up working with Bob Bruce for a while, Walter Schloss, and Andy White. Who wouldn't pay to go to that class? It was like, you look back, you're like, wow, pretty cool list. As I have to also echo what David said, the Heilbronn Center is the best in the business at what they do. They have a long history, very involved in the community, and they have really been the ones that have shepherded this over the years. Really amazing, the milestones along the way. For tonight, we had 19 submissions from MBAs at Columbia, all in the AVI program. The judges, in a blind pick, there were no names, all the names were removed, read the recommendations and boiled it down to 4, which is a lot more work than you can imagine. All right, so this is a little bit of the history. The pitch was originally called the Moon Lee Prize because it was in honor of a guy named Moon Lee who died at a very young age, was incredibly passionate about investing, and was incredibly passionate about his community. And he gave back a lot of time and energy and really had a big impression on the people he worked for. He worked for a guy named Alex Porter, and at that point he met Jeff Holm. And when he passed away, Alex and Jeff came to Columbia. They had no association and said, we would like to start a stock pitch in honor of Moon Lee. And then they changed the name to Amici Capital, which was Alex Porter's. And you did that really in honor because Alex passed away, right? So Alex then passed away. They changed the name in honor of. In 2016, there was no event. 2017, Jeff Holm, who's sitting here, single-handedly, he's not an alum, single-handedly wrote the check to keep the stock pitch alive. Paul Sonkin and I were working on a book on pitching, and he knew James Pan, and James Pan had graduated with David and Jason in 1993, and James Pan and I had been involved in I was a sell-side analyst, we were involved in a position on U.S. robotics. I was negative and he was short, and we got to know each other. And he thought, this guy's a pretty good analyst. And he said, oh, he teaches at Columbia. So he came back and he sat through one class of mine at Columbia Business School in the fall of '93. And then he convinced, when he talked to Paul, he said, you and Johnson should come back. So I show up in 2017 at this event, and they have no idea who I am, which is not uncommon. That's it. And I was about to walk out when Jeff comes walking in, and I introduced myself. He says, come on in. So Jeff kept it alive. The next year, we brought it to Columbia, and Justin Weiss, I have to give him tremendous credit. He and his classmates really helped us keep this alive. The next year, this guy, Tyler Red, won the competition. And then we hooked David and James and Jason and everybody in. And then we called it the Artisan Value Stock Pitch Challenge. So it's been, the reason I want to go through this history is it's because of the passion these people had and the real dedication, loyalty they had to education and Columbia and the Heilbronn Center, that this was something we just had to keep alive. And now it's in great hands and we don't have to worry about that as much. But it's that legacy that you're inheriting, and I think it's really important that you guys start to think about after you graduate, how can I contribute? How can I come back? How can I mentor these students and really be involved? And I really want to impress that upon you. All right, we talked a little bit about relationships. I talked a little bit about this. Without Jeff keeping this alive in 17, I don't think the event would be here today. Without David really stepping up, James and Jason getting involved, I'm not sure we would be where we are. Jenny's she graduated in 94, and she's been intimately involved in the school ever since. So without these people, Paul Sonkin was one of my former students. Artie Williams is here, one of my former students. He and Jenny are partners. You can see the incest continues in the relationship. So Paul was my student. He became my TA. He then wanted to teach on his own. He had this crazy idea to start a class called applied value investing. My class was value investing. Applied value investing, he started the AVI program. So this is the history of the program living as you speak. We talked about Jason. We talked about Jenny. It is unbelievable. This is one of the things that I found out is that when they were in their second year, Jason, James, and David, there was no AVI, there was no Heilbronn Center, there was no value investing program, but they were incredibly passionate about investing. And so they convinced Mario Gabelli, of all people, to help them bring speakers in, which became the blueprint for the Legends class. And it really started with these three and the passion that they brought to it. So you can contribute. You have to contribute. You're going to inherit all of this. It's really important. All right. Near and dear to my heart is pitching. I guess if you write a book on pitching, everything is a problem about pitching. And Paul and I started writing this book in 2013. We were at the Graham and Dodd breakfast, of all places, and I hadn't seen him in a while. He'd been my TA, he'd been my friend for a long time. And I said, "What are you doing?" He said, "I'm writing a book." And I said, "You're a better man than I. A book will kill you." And I had co-authored a book called The Guerrilla Game back in the 90s. And if you're a tech investor, it's still pretty good. And you can buy it for like $1.98 on Amazon used. So, and I get no more commissions. It's long ago.
Not quite there with margin of safety.
Yeah, exactly. Not quite. I know, we just kept printing them, whereas Seth just stopped printing them. And yeah, it's like crazy. So I said, "What are you writing?" He said, "I'm writing a book on pitching." I said, "What's it called?" And he said, "The Perfect Pitch." And I laughed and I said, "Oh, that's funny." He said, "Why?" I said, "Because I always wanted to write a book called The Perfect Investment." And by the end of the weekend, we were writing a book called Pitch the Perfect Investment. It took us 4 years to write it. And we worked pretty hard on it. And it finally came out. We're pretty excited about it. And that was 8 years ago. 7 years ago. 7 years ago, like crazy. All right. So analytical skills. You're taught the best analytical skills in the world are taught at Columbia Business School. By far. You could take 4 of the classes and you have one of the best. Take 40 of the classes. You're going to be unbelievable. The analytical skills of the students coming out is incredibly impressive. The pitching skills, not so great. And so for somebody who wrote a book on pitching, this is my observation. Analytical skills will get you the job, a little bit of pitching. Every interview in this business is a pitch. As Paul Sonkin said, one of my favorite lines, he said, they'll ask you sort of a little bit, warm things up. They don't care. You know, how's school? How are you? How's your family? They don't care. They don't care. They're going to then say, "What do you got for me? You know, what do you like? What are you working on?" And it's all a pitch. So here's my insight to you. If you want to keep your job and make more money and get promoted, learn to pitch. When I talked to David, who is manages the largest fund probably here, I say to him, "What's your biggest frustration?" He said, "Pitching." He said, without a question, that pitching. And the ones like Tyler has taken to this, and he's doing extremely well. Those that learn to pitch get promoted, and this little thing, a bonus. So this will get you your job. That will keep your job. So here's some of the things I just walk away. You don't have to buy the book. Right? Keep it simple. I was talking to the 4 finalists tonight. I'm not a judge, so I can help. And I said, when you think it's simple, start again and make it simpler again. And then when you think it's there, do it one more time. It will feel like you're ripping your skin off. You've done so much work, and you want to impress the judges with all the work you've done. No, you got into the finals by doing all the work you did. Now you want to show them the clarity you have. So keep it simple. And there's a big difference knowing the key issues and proving you did a lot of work. That's 2. Number 2, you have to address ultimately in the job, the PM's objective and subjective criteria, and you'll get to know that. In an interview, here's my advice for you in an interview. All you say at the beginning, before you go into your pitch, this is not an idea for your portfolio. This is just an idea to show you the work I can do. Because if you neutralize them, then they stop, as Paul calls them, Dr. No, I'd never buy it. No, you didn't do enough work, blah, blah, blah. And if you just say, I'm going to show you the kind of work, they become a collaborator and they will help you with the process. All right. Next, answer 4 key questions. This is all that matters in a pitch. We'll see how they did. Number 1, how much money can I make? That's the upside. 2, how much money could I lose? And what we see is a lot of students try to fudge on that a little bit. The 3rd question is the only one that matters. Why is the market wrong? And Paul will probably ask at least once tonight, how long have you been following the company? And you'll say 7 months. And he'll say, why is the market wrong? And if you can't answer that, he's going to be frustrated. And then finally, catalyst, which is effectively, how's everybody else going to figure it out? Stock's going to go to value, and we're going to make some money. Those are your 4 questions. All right. And that's why are other investors wrong? All right. So last year's winner was Amar. He had a long on NSTAR. His price target was 400 in 2 years. It got announced in the summer that it's going to be acquired for 388. Pretty good call. And it's trading at a bit of a discount still. But its 1 year return, 22%. The S&P was up 23%. So we've had a tough year to beat. We're hoping somebody does as well as that tonight. All right. That's it. All right. Thank you. All right. There's the chart. And that's it. All right, Julian.
Hello, everyone. Very glad to be here today. So I'm Morgan. Today I'm pitching for a long for A.O. Smith. The company is currently trading at $67, and my full-year target price is $136, which would be near a double opportunity, and my IRR is 20% in 4 years' time. So just a very quick summary of my investment thesis. It's threefold. The first is this company has a revenue upside coming from favorable regulation change that is currently not priced in. And second, this is a company with very strong pricing power that is going to continue to drive margin expansion, and they're also going to have a cyclical benefit from the commodity price deflation. And third, this company have been treating shareholders pretty well, and they have a good track record of doing shareholder return. So we're going to have a 5% from dividend and repurchase. Before I start the thesis, just a very quick business overview. What does this company do? So A.O. Smith is the largest water heater manufacturer in North America. They have 37% market share in residential space and 54% in the commercial space. I do want to highlight this is a very high quality business. So replacement demand is about 85% of their total revenue. And this is an oligopoly market where A.O. Smith is the market leader and also the price leader. And this is the middleman business where plumbers are real decision makers and very loyal to the brands. And this together are making this a very high quality compounder since 2010, and they're having close to 30% ROIC, and that number is still trending up. If we look at the revenue breakdown, roughly 80% is from water heater, 80% from North America, and roughly 80% is from residential space. So my first investment thesis is about this favorable regulation change that is going to drive the pricing opportunity. So specifically, this is about the U.S. Department of Energy is going to mandate an upgrade to energy efficient product. This policy was finalized in April last year and will take effect in 2029. And this is going to mandate the majority of the electric water heaters going to adopt the heat pump technology, and for all of the gas water heaters going to be condensing gas. So what does this mean to the company? For electric products, which is close to 40% of the total water heater revenue, the price is going to be 2 to 3x. And for the gas, it's going to be 30% higher. So how would that price change affect demand? Here you can look at the unique economics for the consumers. I want to highlight here that the total cost of ownership is actually going to be 60% lower because of the energy cost savings you're going to have throughout the lifetime of this energy saving product. But there are going to be two problems. The first is because the upfront cost is still higher, even if it is offset by partially by the subsidies. So some consumers, as when I was doing a call with the IR, they totally understand that some consumers simply want the cheapest product upfront. So this is going to be a pushback. And the second thing is about retrofits, because for some consumer, it can be big and bulky, and this can also be a potential pushback. So we need to be realistic here. Every time when there's a pushback, there will going to be some workaround. And when I was doing the call with the IR and also read the TIGAS transcript and also did my primary research, typically there are 3 ways of workaround. The first is that for plumbers, every time when the customer is reluctant, they will just suggest you probably can buy 2 smaller models that is less than 35 gallons, and basically you can bypass the new regulation in this way. But I do want to highlight it is still going to be accretive for A.O. Smith if you buy 2 smaller products. And the second thing is for some asset owners whose building configuration do not allow condensing gas, they can switch from gas to electric. And third, they can also, for distributors, it's almost definitely going to happen in 2028 is they're going to do a huge round of pre-buy trying to hedge the regulation change. But the beauty of the stock right at the current time point is that even we have 50% workaround, the IRRs will still be 20%. And even if we have 80% workaround, we can still have the 15% IRR. So which means the market is not presenting any impact from this regulation change at all. And here's the revenue bridge of what is going to happen and as a wrap up. So in the next 4 years, we're going to have this recurring growth driver, which is 3% from annual price increase and 1 to 2% from volume growth. And in 2029, we're going to have this one-time step up of the revenue of 14%. And that is from the regulation change based on the assumption that we have 50% of workaround. My second thesis is about the gross margin expansion, and that's primarily driven by the strong pricing power of this company. And this is because this is an oligopoly market where A.O. Smith is the price leader. And this is also the market where all of the oligopolies tend to cooperate on price. Every time when A.O. Smith put forward a price increase, then other players is going to follow. So since 2010, they've been very successful in introducing 6 to 8% of annual price increase with a 50% of realization rate. And this company has been made a compounder mostly because of their pricing power. Because if you look at their price increase since 2010, it's been up by 236%. And the steel cost, which is typically their favorite reason to justify for a price increase due to steel inflation, it's only been up by 84%. And their secret weapon is more like every time when there's a steel inflation, they were going to do a price increase, but when there's a steel deflation, they never cut the price. So that has been driving the gross margin expansion since 2010. But I do want to point out that right now you can see the gross margin is still at 37%, which is below their pre-COVID level. And the key reason behind that is because this company is still digesting the high-cost inventory they built up during COVID. But we're going to have a cyclical benefit in the next 12 months because if you look at the future price for steel, it is going to be 20 to 30% lower compared to the average cost they built up for those raw materials. But because nobody can really call the commodity price, I'm building this in only for a bull case scenario. So just in the wrap up on what is going to happen for the gross margin, on top of the 33% revenue growth, we're going to have another 12% from margin expansion, and that is from pricing power, and another 5% for the bull case only for the steel deflation. And my last thesis is about shareholder return. So that's 5% annually from dividend and repurchase. It is in line with the company's guidance and also has been well supported by the company's 10-year track record. So since 2010, you can see this company has been prioritizing shareholder return as a percentage of their total capital allocation. And also their shareholder return as a percentage of market cap has been very stable in the range of 4 to 5% since COVID. So before I dive into valuation, I do want to talk about why does this opportunity exist. So the first reason is because we're currently experiencing a cyclical downturn in terms of the volume in the downstream. And that's why this is creating a volume dip and also the dip in the share price, and that's all creating a very great entry point. And the second thing is about the long-term guidance really needs update. So the company having a 5-year guidance that was provided in 2023 and guided through 2028. But the new regulation change was introduced in April last year and will take effect in 2029. So after that, this company never reviewed and revised their guidance. And you can, every time when you talk with the IR or when you dial their earnings call, you'll realize that people do not discuss about it. And even if they do, the management is going to be very conservative. They say we do not understand what percentage of workaround we're going to see. And that's why essentially the market is pricing in like 100% workaround from this regulation change. And also the consensus has been not so sophisticated in terms of building up the model. They just follow the management guidance. So we're not seeing this impact here. And this is like on the one page of the playbook, how to play the stock. So my suggestion would be to buy the volume dip and to hold for the long-term pricing power. This is something that worked in history. If you zoom in, you will see that every time when there is a dip in the shipment, we're going to be a dip in stock price. That typically would be the best entry point in the long term. And if you zoom out, you will see that this company has been made of a compounder because of the pricing power. So if we look at the valuation, the company is currently trading at 18 times forward PE compared to historical average of 20 times. And this stock was transformed from a growth stock to a value stock in 2018. And since 2018, you've seen that they've been mostly trading in line with S&P 500, but right now they're trading at a 20% discount. So that's the deepest discount in history. And this is my valuation. So I'm using a 4 years investment horizon with an exit multiple of 20 times by 2028. And this gives me the target price of 136 with nearly double opportunity and a 20% IRR. And if you decompose the IRR bridge, about 1/4 roughly of the return is from regulation change, 1/4 from the recurring driver of price and volume, 1/4 from the margin expansion, another 1/4 from the shareholder return. So with that, I'm happy to take questions.
I have a series of questions. It's going to take a minute. This is a cyclical business, right? Like if housing drops off.
Yeah, it's like 85.
There's a
Yeah,
replacement cycle. I just replaced mine.
yeah.
It's green, actually.
Yeah.
So I'm intimately familiar with the product.
Mm-hmm.
How cyclical is the business?
It's actually not very cyclical because 85% is replacement. They only have 15% exposure to the new construction. Yeah,
What's the enterprise value?
10 billion.
How much of it is debt?
They're in net cash position. Yeah.
Okay, and then what's the closest industrial comparison? Is it like Carrier or?
Yeah, it's like a home appliance company would be the best, like Whirlpool, maybe a.
What are their margins?
Sorry, I didn't take a look at that, but
What are their EBIT margins for the competitors? Or the comparisons?
I think in the U.S. market, there is not the closest comparison because for the 3 oligopolies, the 2 other ones are private company. But maybe I can take a look at what about those companies. But I do think those companies are not like they're very closely comparable.
What are the margins
versus
for this company?
this company, EBITDA margin is around 24%. Yeah,
And do you not think that that's really high?
that is indeed high. Yeah.
Why do you think it's sustainable?
So because probably just go to my very first page about the quality of this business. So the competition landscape has been very stable and it's more like in oligopoly market where people already started to cooperate on price. And also it's in the middleman business because all of the plumbers are very loyal to the brands because they're only able to do.
I get that. My point
Yeah.
is, it's like you have to have confidence, conviction that the 24% margin is going to hold up. And my point is, well, what are the other historical comparisons? Maybe it's not Whirlpool or Samsung because they have a ton of competitors, refrigerators, dishwashers, things like that. Maybe it's HVAC, maybe it's Carriers. What's Carriers' margins?
Yeah, maybe I can take a look at that.
And if
Yeah.
it's 24%, then you're good. If Carriers' margins have been 24% for the last 20 years, then you can build that assumption on the foundation. But if Carriers' margins are 15% or mid-teens, your 24% margin is a big assumption that is at risk. You got to find another similar product, not the same, that has similar oligopolistic situation where there's only 2 players. And you got to see what those margins are. That's how I would approach this.
Maybe just a little bit to add on that. So first, they've been operating in this business for over 20 years. So they also experienced a lot of the competition, potential new entrants, but they failed to enter this market. And one of the key reasons is because if that's for commercial space, you will have a lot of specifications from the buildings, and they cooperate with all of those builders to work on those specifications. So every time when you have already put the product into the building, when you do replacement, you use exactly the same product. And that's why it's also similar the case for residential space, because every time when your water heater breaks down and when you call your plumbers to replace that, typically just look at the nameplate and that will be calling the plumber who can only do A.O. Smith. So that's why when there is an 85% replacement market, it's actually giving them a great moat, and that's protected in this way.
HVAC has the same thing. HVACs break down every.
Yeah, I do
So
acknowledge
what's
that.
Carrier?
Yeah,
I mean, it's simple. What's Carrier's margins?
yeah, I can take a look at that. Yeah.
One of the observations that I would make is, over time, having seen a lot of change in government policy, I would say more than half the time, those changes don't show up for one reason or another. They get watered down, they get changed, and I know that you're not 100% reliant on that change in government policy to drive your returns. But I would say that is not a fantastic thing to hang your hat on.
Yeah, yeah. So in terms of regulation, it's indeed one of the risk factors that it can be watered down. And I think the benefit is that first, we're actually having two parts in our upside. One is in the cyclical recovery, and the second thing is the regulation change. So even without the regulation change, we still have this cyclical play here. And the second thing is regulation, the mandatory regulation change and the subsidies are two separate factors for this company. If you wire out the regulation change, but you still have the subsidies, actually it's still boosting the market. And right now the heat pump category is still growing at 20% CAGR without the regulation play in place. Yeah. Oh, yeah, sorry. So right now we do not have this regulation that is going to take effect in 2029, but the heat pump technology, the heat pump product are still growing at 20% CAGR. And the reason behind that is we have several states that is providing this subsidy that basically they can just totally offset all of this price difference between a traditional model and the heat pump models. Yeah, already happening. Yeah, 20% CAGR for heat pump technology because the unique economy is favorable, is attractive to some of the consumers. Yeah. And also we had another round that happened in 2015 that is called NAEAC 3. So that is a very comparable policy change that happened in water heater industry. And during that time, this company had a very good revenue growth. They have a 20% increase in price, and also they had a 3% increase in gross margin during that same cycle. 2015, yeah.
When you have an equity at this sort of valuation,
Yeah.
and people get excited about regulatory changes, there can be excess valuation associated with that, and if that regulation doesn't show up, you have to be very careful about that.
Yeah, yeah.
Just an observation. The other observation is a lot of the margin change over the last 5 or 6 years is explained by what you put up there in terms of changes in steel cost. But I also noticed in your work that product mix has changed over the years.
Yeah, yeah.
And you had a Chinese business that
Yeah.
has fallen off over the last couple of years.
Yeah.
And there isn't much in your notes about the impact of those two things
Yeah, I can-
in terms of margin mix. And in addition, though it explains your gross margin, your operating margin has gone up over the last 5 years historically,
Yeah.
and there's not much explanation in that dynamic. And I guess what we would be looking for is an understanding and explanations about what has happened historically,
Yeah.
holistically, and then as we go forward, what might drive those margins relative to the way things have happened historically.
Yeah. So maybe I can explain China because that used to be a very major part in the stock before 2018. So you can see that the blue line here is the profit contribution from China business, and the yellow line here is the revenue. So you can see that revenue contribution from China has improved by from 22% to 34% until 2018, and then it slowed down. But I do want to highlight that China is in a very different business compared to US because China water heater isn't a consumer business, but in US you sell to distributors and you sell to big boxes. So in China you have a slightly higher gross margin, maybe just 1 or 2 percentage point higher. So that's in terms of mix, it's going to help your gross margin a little bit. But in terms of EBIT margin, China's EBIT margin is in the range of 10 to 14%, much lower because you have all of the stores and personnel. But in the US, the EBIT margin is in the range of 24%. So if you look back in history, what has been driving the EBIT margin improvement, still mostly because of their pricing power, because they're able to put forward this price increase and they can benefit from the steel deflation later on. Yeah, so that's...
Pricing power should show up in the gross margin, not in the operating margin.
Yeah. Yes. So in my main page, I was connecting that with the gross margin part. Yeah. And China, if you look what is currently where we are in the cycle right now, so China is actually much less important because we have this property down cycle, but most of that has already been reflected in their price, and that was the key reason why the stock has dropped a lot since 2018. And also it's reflected in valuation because China made this company a growth stock before 2018, but right now it's more like a value stock valuation. Yeah.
Could you just quickly touch on your bear case? I think it's $3.62 of
Yeah,
earnings.
sure.
Just like what assumptions go into that?
Sure. Yeah, so this is my bear case and this is my base case. So there are three key differences. The first is, as we mentioned in the main pitch, the percentage of workaround. So in the base case, I'm using 50% of workaround. In the bear case, I'm using 80%. So that's a huge number. And the second thing is how fast we can pass on still inflation, because nobody can really call the commodity price. As you can see in 2021, they used to get hurt because they cannot pass that so smoothly because just the steel price went up so much. So what if we have a cyclical hiccup during that investment horizon? So that's a little bit different, and that's why we're seeing the difference in gross margin. And another important thing is in their SG&A, because they were able to cut the cost during COVID. And main reason behind that is they're cutting the advertising spending in China. But right now, they're still doing restrictions. They're still trying to cut more cost. But I'm assuming in the bear case, they are going to return all of those benefits. I'm just assuming that they're going to be getting into the price war, do all the spendings, but they're not going to have any revenue benefit. So that's the bear case. I think that's a quite conservative assumption for this company. And yeah.
Okay, so just to make sure I understand. So
Yeah.
if this company, if there's an 80% workaround,
Mm-hmm.
which is sort of almost the equivalent of saying something happens in government and
Yeah.
the regulation doesn't happen.
Yeah.
So if there's an 80% workaround
Yeah.
and their SG&A costs go back to
To pre-COVID level.
pre-COVID
Yeah.
levels, they're earning 362?
Yeah, yeah. In the bear case, yeah.
Okay. So what if we assume like no China workaround / regulation doesn't happen, but they keep their SG&A? Because a lot of companies have figured out how to do more with less
Yeah.
since COVID.
Yeah, so in the bear case, my net margin is in 10%, then you will have like 13% net margin. So that will be the difference in EPS if you do not have this SG&A problem.
Yeah.
Yeah.
Yeah. Okay. Great. Thank you.
Oh, thanks. I guess two questions. First, it looks like most of their sales are North America and China. Are there competitors in Europe and South Korea and Japan? And if so, do they sell in the U.S.? And the second is on the inventories. Are they on LIFO or FIFO? Do you know?
Yeah, sure. So first the question, in the US, it's just three dominant players. So the other two are private companies, but they're still US players. Yeah, so China Haier acquired GE Appliance and entered US, but still they're still very struggling to get market share, mostly because of this plumber problem. They're reluctant to adopt Haier's product. So that's the landscape in US. And second question, you asked about inventory, right?
Yeah, on the inventories, do you know if they're on LIFO and FIFO? And if they're on LIFO, it
Yeah.
seems like the steel costs from a few years ago should have flown through. Excuse me, flown through the income statement by now. So it doesn't seem like there should be any impact currently.
Yeah, I think So I kind of forget their accounting policy. I apologize for that. But I think when I did that, I was doing the number of days outstanding. So as you can see that most of the inventory problem is actually from the raw material, but the finished good is actually fine. So I'm assuming that most of the inventory problem is because of the high cost steel they acquired during that period. But that's a good question. I can follow up on that. Yeah.
Okay, you got 30 seconds. Great, thank you very much.
Thank you.
Good afternoon, everyone, and thank you all for coming here to hear our stock pitches. Today I'll be presenting my long thesis on CNH Industrial, ticker CNH on NYSE, which I believe will be close to a $20 stock by fiscal year 2028, up from around $13 today. CNH is my largest position, and I started buying shares after starting my AVI course at around $11.20. CNH Industrial is the second largest manufacturer of agricultural equipment worldwide and a leader in construction equipment. The company primarily competes with Deere, AGCO, and Kubota, who collectively share over 60% of the market. Construction is a much more competitive business with many more competitors and less brand loyalty. Competitors here include not only Deere and Kubota, but also Caterpillar, Hitachi, and Liebherr, just to name a few. CNH is held by the Agdeli family through its holding company Exor, which owns a 30% stake. Over the last few decades, the company went through various mergers and demergers, but today is a pure play in the agriculture and heavy equipment industries. Note the company had its primary listing on the Euronext Milan exchange since its IPO in 2013, but it became solely listed on NYSE in January 2024. Garrett Marks became CEO of CNH in July 24, taking over from Scott Wine, who was in place since 2021. Marks comes from within, having served as president of the commercial vehicle business from 2019 to 2022 and CEO at Iveco following that segment's spin-out from CNH. Marks has a strong background in efficiency from his time leading operational change and transformation efforts over 15 years at McKinsey and Bain. His efforts are already paying fruit via structural profitability improvements, which I will discuss later in the presentation. Organizationally, Marks simplified the org chart. Newly promoted regional leaders who uniquely understand the business are promoted from within and are responsible for their own P&L. They roll up directly to Marks, who's also head of agriculture. As for the other verticals, Humayun Chishti and Douglas McLeod serve as presidents of construction and financial services, respectively, and both have spent nearly their entire careers at CNH. I want to spend this presentation talking about agriculture, which is responsible for nearly all of CNH's profitability. Higher product differentiation, customer loyalty, common factory parts, and digital integration make agriculture have margins 700 basis points higher than construction. The old on-highway business was even less profitable, and its spin-off refined CNH's focus and shored up CapEx spending substantially. Despite the current agriculture down cycle, agriculture EBIT margins are higher than at any point in CNH's listed history, barring 22 and 23. CNH comprises 10.2% of the Agnelli's holdco portfolio, which makes it a meaningful contributor to the group's profitability. This is reflected in a culture of conservatism company-wide, a sentiment which comes up with every former employee I have spoken to or interviewed through Tegas. Current management has a goal to distribute all excess free cash flow as dividends and buybacks after small M&A funding needs. The business has been simplified significantly over the last few years, culminating with the primary transfer to NYSE, which increased volumes threefold. According to a paper from 2011 Kansas City Fed titled "This Time is Different," agriculture fortunes follow a predictable cyclical pattern over their analysis period of 100 years. The two primary drivers of the cycles are farm incomes and interest rates, both of which are currently unfavorable. This data is reflected in price expectations and farmer sentiment, which troughed late last year. With the advent of arrangements between manufacturers and dealerships, channel inventory also affects how many tractors, harvesters, and tillage equipment can be sold wholesale. First, I want to touch on farm incomes and sentiment. Given current relations between China and the U.S., many farmers feared that a new Democratic administration would not support them, with government assistance like President Trump had in 2019 and 2020. The recent election results caused farmers' future expectations to surge to their highest levels in 3 years, as his win effectively backstops farm incomes, which are depressed by the ag cycle. Furthermore, the two major cash crops in North and South America, which are corn and soybeans, have increased in price 25% and 13% respectively. I believe corn has surged due to Trump's previous actions on ethanol, which included a $100 million investment to increase biofuel sales. On day one of his new administration, Trump expanded access to E15, which is a blend of gasoline with 15% ethanol content, and farmers are pushing for even higher blends of E20 or even E30. Agriculture Secretary nominee Brooke Rollins told senators last week that Trump would support the ag community, whose vote she claimed was a key victory that secured the president's victory. Dealer inventories of farm machinery are about $1 billion above trend, which has been communicated by management on the latest earnings call, and you can also see that via the long-term average on the Fred data series I have plotted there. Destocking is occurring rapidly, evidenced by inventory at publicly traded company Titan Machinery, which is CNH's largest dealer. Inventory fell 7% quarter over quarter, the largest contraction on record. The company will keep destocking via large discounts on used, older machinery to clear the channel for higher margin, higher tech CNH products in the mid-cycle. Titan is only forecasting a mid-single-digit decline in revenue due to these efforts, while AGCO, Deere, and CNH are all forecasting 20 to 30% declines in 2025. The previous down cycle in the mid-2010s was closer to 5 years than 3, as manufacturers continued to stuff the channel to pad revenues. The big three have all communicated that this time will be different. I believe CNH enjoys idiosyncratic factors that make the stock more favorable than its competitors, AGCO and Deere, and I'm going to touch on these each individually. The first is profitability improvements. So Garrett Marks accelerated efficiency, which was efficiency efforts, which were started under Scott Wine, but were happening too slowly, which is why he was deposed, I believe. He has reduced COGS with strategic sourcing initiatives that hold supply chain leaders accountable for tight control of part costs and quality. This has been bolstered with technology that has improved warehousing operations. I spoke with a former supply chain analyst at CNH who is currently at Caterpillar, who spoke about his group's project to control inventories much more tightly, monitor the cost of parts and their quality from different suppliers, and use software to automatically calculate the number of parts needed across the warehouse for the current backlog. He described the culture at CNH as friendly, warm, and welcoming, with senior leaders visiting the warehouse and congratulating the team on its efforts. As for SG&A, the company culled its headcount in May 2023 and has closed certain underperforming plants, particularly those making construction equipment. There's also been much more discretionary spending oversight under Marks, and combined, this has led to a 200 basis point reduction, only to a 200 basis point reduction in agriculture EBIT margins, and even a slight increase for construction margins. CNH has lagged behind Deere when it comes to precision ag, which is the main reason Deere's operating margins are 700 bips higher. But the company began pursuing an in-house precision ag strategy in 2019, which slowed in 2020 and 2021 after previous CEO Scott Wine slashed R&D spending. This has led to a costly acquisition of Raven Industries for 7 times revenue in 2022, as the company had to play catch-up. Today, R&D spending as a percent of revenue is the highest in history, and the company has integrated Raven to the point where nearly all precision tech solutions will be made in-house by 2025. Note that farmers can buy this technology via implements to their tractors rather than purchasing a new tractor entirely. So even if the down cycle is prolonged, entirely in-house implements should hit the markets in 2026. Deere's profit margins for precision ag are 26%, by the way. There's also technical factors that I believe are depressing CNH. When it delisted from Milan, there was about $2 billion of forced passive selling from European institutions. Some of this was mitigated with a $1 billion buyback, but the company lost its base of consistent flows. This is also changing. CNH was added to the S&P Midcap 400 index in September 2024, and passive ownership has increased. One iShares ETF alone owns 2% of CNH, which is crazy. The name also screens poorly on services like CapIQ, causing it to appear over-levered and richly valued. This is due to the finance segment, which is a separate box from the industrial segment, and it has its loans matched up with receivables. Deere has similar dynamics, but due to CNH's much smaller market cap, you could see that it proportionally affects the enterprise value much higher, leading to a lot of analysts to just not even see this name on their screens. I estimate EBIT in 2028 will be $3.6 billion on agriculture revenue of $17.8 billion. This differs from street estimates materially. For example, one long-run estimate from Morgan Stanley sees 2030 agriculture revenue as the same as it was in 2021, while the industry was still challenged. If we're still in a down cycle by 2030, it would be the most anomalous down cycle ever. I expect the mid-cycle to begin in 2026, continuing into 2027 before the first year of the new upcycle in 2028. I ascribe a conservative 8 times EBIT multiple to the business, which will have crystallized structural improvements and likely be a pure play in agriculture, following strategic alternatives for construction. That's not baked into this, by the way. It's just a potential upside case. This leads me to a target price of $19.75, up from a current price of $13.16, for a healthy margin of 22.9% safety. For a healthy margin of safety of 22.9% with a 10% discount rate. And with that, I'm willing to take questions.
So, why do some of the farmers buy one of CNH's product brands versus Deere or Massey Ferguson?
So there's massive brand loyalty. I went on this forum called TractorNet, and they have debates over red versus green, which is Case IH and Deere's equipment respectively. It has to do with kind of what their parents and grandparents and great-grandparents were buying. These are really rich brands with a 150-year history. So the brand loyalty in agriculture is massive, and it's unlike construction, which is part of the reason why the margins are so much higher.
So what's the repeat rate on?
Excuse me?
The repeat rate. If you bought it last, if you bought New Holland last time, what's the repeat rate?
It's extremely high. It's over 90%. Oh, okay. But it's like that for Deere as well. Okay. But CNH doesn't need to win share. I think they just need to maintain their current share and use having a stock that's just significantly undervalued.
Can you just walk through the financial part of the business and the balance sheet, kind of ex-finance? And kind of what is the balance sheet risk on the financial services side?
So they have about $24 billion of receivables on that segment, and those are all paired off with debt, both asset-backed securities and unsecured debt. I guess what I'll point to with the risk is their delinquency rate, which I think is the major risk. But they underwrite very conservatively, and their delinquencies on book are between 1 and 1.5% normally. You'll see the recent uptick in delinquencies in a fiscal quarter ago. That was due to Latin America. I spoke with IR, and they said that's been resolved. Latin America was particularly soft due to very poor soybean harvests that have now resolved due to. Correct, they are.
What do you mean by conservative? What's their underwriting process?
So yeah, they just have a culture of conservatism when it comes to underwriting. You know, they'll poll the credit agencies, they'll look at FICO score, they'll look at all of those traditional metrics. And when you look at a normal
Credit agencies in Latin America.
no, but there's like respective ones. And you know, when you look at delinquencies for Deere, for example, they're also in the 1 to 1.5% range. But Deere is selling to a customer that has 20 to 30% higher incomes than CNH. So I think it just kind of speaks volumes to.
How did the credit look during 2008?
CNH wasn't public in 2008. They went public in 2013.
How did Caterpillar's, Deere's look during 2008?
Yeah, I could get back to you on that, but I haven't looked then.
Or actually, you can get a look at what happened in 2008 and 2009 due to the fact that they were factoring receivables. People in the United States have been buying them. But the credit book's also wholesale finance.
Yeah.
So what happens in an environment where that financing dries up? What percentage of their products are sold on credit?
Yeah, so it's very high. Their main distributor is this company called Titan Machinery. They're a publicly traded company because they don't have their own dealer network. Financed sales, both for used and new, account for over 70% of sales. You know, I think given that the down cycle currently is the most dramatic down cycle in many decades, it's over 70%. But I think since the down cycle this year is like one of the most dramatic in decades, and you haven't seen a blow up yet, is a reassuring sign.
And if you look at the percentage of product that's sold on credit through the down cycle, what's happened to it?
To
To the percentage of product sold on credit during the down cycle, what's happened to it?
the percentage of products sold on credit, I'm not sure how the percentage has evolved.
Okay, so the company wasn't public, but was the asset-backed securities public in 2008? And are there records of it and how it performed between 2007 and 2011?
Yeah, I just need to check on that. My analysis kind of started when CNH went public.
Could you go to your financials tab?
Yes.
So I guess 2028, 2029, I guess, or 27, 28 is when you're calling, I guess, the upcycle. Yeah, the ag industry, I guess that's where you get the juice on EBIT increases. Why don't we just buy corn futures with 2029 expiration? It just seems like the ag cycle is very important here, and there's other ways to express that.
Yeah, so I think this business is just a lot more than corn, soybeans, and wheat. You also have a management that is focused on profitability improvements. So, you know, with those, maybe you get like the top line component, but I don't think you get the EBIT margin expansion component due to those improvements in COGS and SG&A, which kind of give the business leverage.
And then I guess the EBIT improvement 2021, 2022, I mean, how much of that was their own actions versus what I think the whole industry was constrained on volume so you could sell?
Yeah.
So you could just jack up prices however much you wanted?
Yeah, so they took a lot of price then, and the former CEO kind of failed to implement these structural improvements. Like there was a lot of bloat in the company, which is why you were able to have the spinoff. Yeah, so, James?
Oh, no, I just want, so how did you value this business? Did you do it as a multiple of EBIT?
I did. So I took
Time out. You can't do that with a cyclical. It's meaningless. You have to look over a complete cycle of not just this company, but its closest competitor, and see what the average EBIT margin is through the cycle, and use a multiple of sales based on that EBIT.
Yep.
If you look at this, if you put up the margin thing, it was like, okay, the margins are all over the place, but if you average it out, it's close to high single digits, maybe 10, maybe 11. So a fair EBIT revenue multiple of that, because revenue is much stabler than EBIT margins, is 1.2, 1.3. That's the multiple you should use.
Well, in this case, actually, EBIT has kind of been more stable than revenue due to those profitability improvements. You're going to have revenue decline in the agriculture segment, for example, from 18 to 14, whereas EBIT has kind of hung in there. And if you kind of look across the whole cycle, in 2016 was a very severe down year for the company. You still had a 10.6 times multiple ascribed. I think kind of due to some of those dynamics on the forced selling, you haven't seen the multiple re-rate to that level, which is why I feel pretty comfortable with an 8 times multiple, given the 2013 to 2017 period captures a full cycle. That's why you see the bump in 2017 to 3.8 times. The trough in 2018 is due to fears over tariff retaliation. And then you see the multiple bump up again when they saw that the president would be supportive of those farm incomes. And he actually backstopped all of farmer incomes due to losses from the tariffs.
Can you talk about why the margin spread is so different between Deere and CNH?
Yeah. So
On the ag business.
yeah, it's a great question. I have a slide here. It's due to precision agriculture. So you can see that the margins were a lot closer in 2013 to 2017. They kind of both had unfavorable dynamics due to the cycle. Deere, though, has been creating in-house precision agriculture since the late 90s, and they kind of reached this inflection point with COVID. Farmers are kind of a lot more frugal now due to the current cycle, and they want technology that can tell them exactly where to plant, how much to plant. They don't want to waste water or other resources. There's a 700 basis point difference in EBIT margins right now, but the company, I think, will boost their EBIT margins through improving their in-house technology stack, which they're currently on pace to do in 2025. They just affirmed that at their tech day last October.
And wasn't it Scott Wine that actually purchased the company that's going to help them close that gap?
Correct, but the reason he purchased the company is because they slashed R&D spending in 2020 and 2021, and those 2 years of cumulative underinvestment forced them to make that panic acquisition of Raven for 7 times revenue, 80 times EBIT.
And wasn't Scott Wine's track record pretty good before he showed up here? And
Yeah.
wasn't he running this pretty well by the time he left? And wasn't his departure pretty abrupt? So if you could handicap that for us.
So
What were the reasons?
Scott was previously at Polaris. I think a lot of people are questioning whether his performance at the company was smoke and mirrors, given what happened at CNH. I think the reason Scott benefited was because the agriculture upcycle was a rising tide that benefited all ships. I don't really think you can give him a lot of credit for CNH's good stock performance during those years. What he did do was that he kept a lot of bloat in the company that's being slashed right now with like little effect to the top line. I do give him credit for spinning off the on-highway business. I think that was important. And I do give him credit for starting the process that led to the relisting to New York Stock Exchange. But Garrett has kind of been a superstar in reorganizing the organizational chart and having these two global heads of construction and finance and simplifying things greatly so that he's the head of agriculture. He knows the whole business is focused on that segment. And the regional leaders can look at the P&L in their own region. They know exactly their regional dynamics and are compensated based on that.
And lastly, can you talk about the regional differences and the product line differences in the agricultural business between these two companies?
Yeah, so CNH has 2 brands. It's Case IH and New Holland. Deere has numerous brands as well. I don't know them off the top of my head, but Case IH is much more popular in South America and United States, I believe, and New Holland is a lot more popular in Europe. But both brands have a lot of loyalty in those regions.
Can I just ask you on your financial? So your the downside until we get the inflection is about $1 to.
Yeah, it's like about $1 of EPS.
So what do you think? So you showed the 8 times EBIT chart, but I mean, what do you think the downside is while we're waiting?
I think the downside is that the down cycle is more prolonged than expected. You discount the cash flows, you discount the EBIT at a longer rate, and I think the reassuring thing with this business is that it's never really traded below like a 6 times multiple. So even if right now you have 2 turns of multiple compression and you have EBIT that's closer to 2,500, well, that's an enterprise value of $15,000 by 2028, which is about like a $10.50, $11 stock. About $10.50. I think that's why So David Einhorn began accumulating a position in December. And I think the reason he did that was that he saw that it's as bad as it gets at that point, and you're kind of backstopped at that price.
Can you just talk a little bit about return shareholder capital? Like I see in 2016 to 17, they bought back like 500 million shares. Is that correct?
In 2016 and 17?
Yeah, and then can you just talk a little bit about their view on buybacks and
Yes.
then this dividend and how safe it is?
Yeah, so Scott reiterated this during the latest earnings call. They're committed, with the exception of very small M&A, which will be focused on precision agriculture, to returning all capital via dividends and buybacks. Their dividend right now is about 3.5% yield. Their buybacks have trended at about 6 or 7% annually since they began the program after the delisting from Milan. So you're looking at a shareholder yield that's like high single digit.
If nothing happens. So you get paid to, so you're sort of saying you get paid to wait.
Yes.
I know it's small and it's going to get spun off, but on the construction business, why are the margins so low?
Excuse me?
The construction business, it's not material to the case, but it's small and it's going to get spun off.
Yep.
I'm just kind of curious why are the margins so low in that?
So it's a super competitive market. You not only have Deere, AGCO, Kubota, and CNH make up 60% of the market, so there's a pretty good pricing power. When it comes to construction, you have a lot of Japanese construction companies as well, like Hitachi. There's a lot more. I don't know them off the top of my head, but basically they don't have product differentiation. They don't have opportunities to incorporate like precision agriculture. It's a lot more, construction equipment is a lot more of a commodity than agriculture. There's not a lot of brand loyalty either. You don't have the brand loyalty of like your local farmer in the Midwest. You have these massive megacorps buying these, huge lifts and whatnot.
Do you think that on the agricultural side, CNH can catch up to Deere? Is there structurally some reason they can't in terms of the margins?
I don't think so I'm being realistic. Like, I really don't think they can catch up to Deere, but even if they close the margin gap by 200 basis points, which is not contemplated in my base case, by the way. My base case incorporates the SG&A and COGS improvements that Garrett has crystallized. If they can, you're looking at a stock that's in the low to mid 20s rather than 19.
Why is there a structural difference between the two margins?
Well, I think Deere has been in precision ag since 1996. CNH only started looking at it in 2019, so there's 20 years lag between the technology. Nevertheless, I think that's the reason why Case IH and New Holland have so much brand loyalty. Those tractors are 20 to 30% cheaper than Deere tractors due to their relative simplicity. And I think they will get more advanced over time, but farmers are fiercely loyal to the brand. What's the replacement cycle? Yeah, it's a great question. So I talked to this dealership in the Midwest. They say a tractor can last for a minimum of 4,000 hours. Your average farmer is using the tractor for 500 hours a year. It's interesting because the company said in 2023 that customers were starting to delay their purchases. So the critical period is kind of like 4,000 to 6,000 hours. So customers really can't delay their purchases more than 4 years, right? If they were at that 4,000 hour threshold to start with, and then you wait 4 years, 500 hours each, you need to replace your tractor. So that's part of the reason why the upcycle why I think there will be an upcycle in 2028, because not only will you get the benefits from the new administration and lower interest rates, but you're also going to get tractors that need to be replaced.
I'm excited to be here and to present an attractive investment opportunity in global payments. I propose going long the stock with an FY27 price target of $174, implying an IRR of 16.7% over a 3-year holding period, with a risk-reward skew of more than 5x. My thesis is three-pronged. Firstly, contrary to its perception as a legacy payments technology business susceptible to steady erosion of market share by digital-first peers, Global Payments is a leading player with scale and capabilities to maintain and expand its position within its SMB niche. Secondly, management's capital allocation strategy over the next 18 to 36 months will be significantly accretive to shareholders, even if the business manages to just tread water, capping downside for investors. And finally, the current CEO prioritizes creating shareholder value over the acquisition-driven growth, which has marked the past decade for the company, And this should provide investors with the confidence that they can bank on Thesis 2 getting executed. I want to highlight that my forecasts are modestly above consensus estimates, but I believe that the key drivers backing my positive variance are more reliable, as I will explain later. So what does this business do? Global Payments is one of the top 5 merchant acquirers in the US and provides payment processing capabilities to more than 5 million merchants, processing 75 billion plus transactions annually in 40 plus countries. Last year, it processed close to $1 trillion in payment volume. And for comparison, Visa and MasterCard combined processed about $20 trillion of payment volume. So what does an acquirer do? And how do they make money? In a nutshell, an acquirer connects merchants who sell goods and services through a card network to card holders who pay using a credit or debit card issued by an issuing bank. And I want to highlight, as you can see in the image on the right, that in the payments value chain, the acquirer pockets the smallest piece of the pie, with the lion's share going to the issuing entity. And I believe this gives the acquirer relatively better positioning to take price in this ecosystem. So how did we get here, and why am I talking about this business? So post Q2 results in 2021, the stock tanked 10% and the multiple compressed below SPX versus historically being priced at a 30% premium. And management came out all guns blazing at the investor day and highlighted that over the last 8 years, adjusted EPS had grown at a 20% CAGR. And also that merchant acquiring volumes had grown faster than Visa and MasterCard credit, which is the strongest indicator of market share gains. But they went wrong in 2 aspects. Firstly, management forecasted that tech-enabled revenues would reach 75% of the mix, incorrectly extrapolating the pull forward in digital payment, which happened during the COVID period. This did not materialize because, as the past 3 years have shown, Global Payments' business model is more levered to SMB customers and requires a conventional sales force. As a result, tech-enabled revenues did not grow at the projected rate as a slice of the pie. Secondly, management headed by then CEO Jeff Sloan set extremely aggressive targets, untethered from the historical performance of the firm, in an effort to appease the market. And the company fell short of meeting these revenue and growth targets, as a result of which the multiple compressed from 20 to 25 times forward earnings to 8 to 10 times forward earnings. I also want to draw your attention to 2 major acquisitions that the company made in the past 5-year period, orchestrated again by the former CEO. These acquisitions tend to be debt financed and were made at premium multiples, which extracted value from equity, especially as the multiple compressed. As a result of these developments, the stock price declined about 50 to 60% from its post-COVID highs, and it's kind of treaded water over the last 18 months. In June 2023, Mr. Sloan stepped down as CEO, and the COO, Mr. Cameron Brady, took over as CEO. So why do I believe there's an opportunity here? The bears believe that Global Payments is a legacy, structurally disadvantaged player in a competitive industry moving towards digital-first operators, and as a result, it'll face a slow bleed of market share to peers like Stripe, Block, and Adyen. Their belief stems from the much higher growth rates that players like Stripe have sustained over this time period, in addition to the rapid growth in market shares, which is a result of them winning the fastest growing parts of the economy, like tech businesses. But I'm here to tell you otherwise, backed by 3 reasons. Firstly, I must concede that there is some truth to the bear argument. My conversation with industry executives highlighted that newer players disrupted the merchant acquiring space by capitalizing on the tech transformation of the payments infrastructure and focusing on building payments APIs, which are easier for developers to understand, integrate, and scale. But Stripe and Block have been around since the 2010s and operating on the same business model. That hasn't changed in the last 5 years. What has changed is an accelerated rate of electronic payments growth, which is an industry-wide tailwind. During the same time period, Global Payments has not only managed to grow revenues by 18% and adjusted EPS by 40%, but also expanded adjusted operating margins by 500 basis points, while maintaining its market share of transactions amongst legacy players. Additionally, Global Payments has historically focused on the small and medium business segment, which does not have a lot of overlap with the core customer of digital-first players. SMBs make up 44% of GDP, and Global Payments' merchant solutions segment, which earned $7 billion in revenue, operates in a $100 billion market. So they're nowhere close to plateauing out on their ability to grow while focusing on this slice of customer. Also, contrary to the bear thesis, the e-commerce segment within merchant solutions has sustained double-digit growth rates, lending validation to my thesis that Global Payments is not an obsolete legacy player incapable of adapting with the times. Secondly, management has outlined a plan to return $7.5 billion in cash to shareholders over the next 3 years, which I estimate should reduce share count by about 20%. The company has $3 billion of cash on the balance sheet, a 5-year high compared to the historical $2 billion average. And its business operations currently generate about $2 to $2.5 billion in levered free cash flow, and it's poised to improve, which makes me believe that this strategy is feasible to execute. And since 2021, the company has reduced share count by 13%, which shows that this is not a knee-jerk reaction made to just appease the market. But based on what I told you about the acquisitive history of the company, I'm sure you're wondering what's changed for us to believe that they're going to execute on this. Well, the CEO, for one. Global Payments' history of growth through acquisition was an idiosyncratic strategy employed by former CEO Jeff Sloan. I spoke with a former board member who oversaw Jeff's tenure, and he highlighted that given Jeff's history as a successful financial technology investment banker, he entered this role with a specific agenda to grow the business by diversifying its revenue streams. The current CEO, Cameron Bready, has clearly stated that he plans to limit acquisitions and prioritize share repurchases. And over the past 18 months, he has shown that he will not put your money where Jeff's mouth was. Global Payments has made no major acquisitions since June 2023. And in fact, they've divested non-core verticals to streamline the business. From 2021 to 2023, about 45% of their capital deployed was towards M&A. Since Mr. Bready took over in June 23, that number has shrunk to 20%, along with an increase in the percentage of capital deployed towards share repurchases. In conclusion, I believe being long Global Payments today offers an opportunity to earn mid-teens returns by investing at depressed valuations in a competent top 5 player, which has managed to prove that it's here to stay, aided by a management team which is now focusing on making capital allocation decisions which help shareholders, not just the top line, along with levers that they can prove to the market that they can execute on the strategy even if the market doesn't believe them. And if there's one thing this company knows how to do, it's to ensure that you get paid. Thank you for your time and attention. I look forward to your questions.
Did I miss it? What's the enterprise value?
It's about $42 billion,
And how much debt?
about $18 billion.
18 billion?
Yeah.
And what is the EBIT that you were hoping for?
Yeah. So adjusted operating income as of this year should be about $4 billion.
And you said the EV is 45 billion?
42 billion.
Yeah, okay, so it's 10 times EV.
Yeah.
Okay. So you mentioned a lot of times about like the financial engineering, which is buybacks and stuff like that. If there's one thing that Boeing and Intel has proven, how are they investing to make sure that the customer gets more value over time? Where's that? Is the transactions happening quicker? Are they lowering the cost of the customer?
Yeah. So there's 2 segments. One is merchant solutions, where they're processing like payments for merchants and helping them like settlement, authorization, and chargebacks. In that, there have been a lot of tech developments, and a lot of that has kind of been spearheaded by the digital-first peers like Stripe, Block, and Adyen. For example, you have embedded payments. So now when you pay on a website, you're not redirected to like your payment authorization website, and there's a lot of back-end integration which happens. So they have added those capabilities. And what my primary research indicated was this is not a company which is historically at the forefront of innovation, but the innovation in this space is such that, at least that's what the board member told me, is that they know that they're not going to be first to it, but once someone else does it, it's not hard for them to catch up to it. So, and that's also reflected in the value proposition. So if you look at the pricing, if you go to Stripe's website today, and if you're a small merchant, you are not going to get enterprise pricing, which is interchange plus. So if I go here, so as you see, most of the revenue here most of the profits are earned by the issuing bank, which is interchange. And if you're an enterprise and you have negotiating leverage, your pricing is IC plus. So the spread that you earn is much smaller, and you get custom pricing. If you're a SMB customer, you don't have that negotiating leverage. So Stripe's pricing is 2.9% of transaction value plus 30 cents. Clover is like 2.3% plus 10 cents. Global Payments doesn't publicly disclose it, but it's definitely like priced according to the kind of customer they have. So they're late to the party, but not in a position where they cannot keep up with the leading edge players.
I noticed on the free cash flow per share, it went from about 610 to, I guess, 1110 from 23 to 24.
Yes.
What's kind of causing that hockey
Yes. So that's a one-time release of working capital. So they take and release cash because of the settlements that they process. So if you see my forecast for 25, there is a drop there because I'm not accounting for that one-time release. And also, I just want to point out that 2024 it's an estimate, but they've reported 3 quarters of results, so it's mostly going to be in line.
Although 25 is still a pretty good increase from 22, 23, 21.
Yeah. So that's also because with the new CEO, they've kind of streamlined their capex, and they're not spending as much on like buying businesses and trying to integrate them. And as a result, like streamlining the business is also reducing like integration costs for them. So if you look at just the number of businesses that they own, like they own a lot of businesses. So the main ones are Global Payments and TSYS, which is the issuing processor. But they bought a lot of businesses within verticals. So like they had a healthcare-focused payments company, they had an F&B-focused payments company, and they've kind of streamlining a lot of those costs. And a lot of it is a part of it is also coming because they're currently migrating their issuing processing to the cloud with AWS. And as that happens, that's going to like streamline like cash flow.
Can you go to your market share slide?
Yeah.
I think it's in the appendix. And you can see that competitors that are roughly in the same sort of older technology area, Fiserv and WorldPay, have gained serious market share over the last few years. Could you talk about why there is, and JP Morgan as well, can you talk about why that's the case and why Global Payments hasn't kept up? Why are they losing so much market share?
So with Fiserv and FIS, one thing which has also happened is like in 2019 when Global Payments bought TSYS, Fiserv bought First Data, and I think FIS bought WorldPay, which they've now sold. As part of that, they also acquired Clover. So they were kind of earlier to the party in terms of acquiring a digital first player. So if you go to a lot of like brick and mortar stores or like restaurants now, you'll see like a Clover payment. So Global Payments was not tethered to that growth in the market share. So they were like historically focused more on like SMB customers. And also, if you look at their trend in market share, they've broadly maintained it. And if you look at the reduction from 2020, 21, 22, that reduction is as a share of the overall market, not only amongst legacy players. So as a share of legacy players, they're still kind of keeping up.
And that difference in scale doesn't matter?
Well, it definitely does matter, but to the extent that the customer that they're servicing is slightly different from the customer that, say, Stripe is servicing or FIS is servicing. And if they're looking at more enterprise customers and they're in a market where the overall customer is growing at a higher rate. So if you look at, so I talked to someone at Stripe who manages strategic partnerships, and he mentioned that the new players, when they entered this market, their whole thesis was that we need to be in a high growth market. So we need to cater to startups. And if we build a payments product which is tightly integrated with startups, we don't need to go and look for new customers because we can continue to grow as the overall market grows. So they've grown their market share because not because it's because the overall pie has increased. It's not because their increase in the pie has come at the expense of where Global Payments operates. And in the long term, like the company is trying to adapt, but I don't think that they're immediately going to encroach on this space in the next 2 to 3 years, which is the investment horizon.
Maybe a comment and then a question, I guess, on your thesis point 3. I think the CEO had his fingerprints all over the past acquisitions.
True. So he's been with the company for the past decade, first as CFO and COO. But the way I thought about it is, if he was built in the same mold as Jeff Sloan, after he's had 18 months where he's had the top job and he's free to make the decisions. If he wanted to continue with that, he could have. But instead, he's publicly stated that at this point, they're prioritizing share repurchases. And his actions of the last 18 months have shown that he's willing to walk the talk. So although he served as an operating executive under Jeff Sloan, after taking the CEO job, his actions have been in a different vein, which gives me confidence, especially based on the amount of capital they're deploying and they can deploy, that this strategy is something which is feasible to execute. The lack of acquisitions? So to that point, one, interest rates started rising in 2022, and he took over in 23. And rates have begun reducing now, but they're not immediately going to reduce by a large margin. So to the extent that this cash can be deployed over the next 18 months, I think that can still reflect in the stock price, even if they go back to their old roots and make an acquisition sometime in the future. So just the amount of cash they have, if they deploy it within the next 18 months, I think there is potential for the stock price to reflect that.
Just one more thing, just on the market thinking it's kind of a melting ice cube. Why hasn't private equity or activists showed up? I think Silver Lake's been here for 2.5 years. They haven't made money, and then GTCR bought WorldPay, so there's interest. I mean, this is 8 or 9 times. You could put a lot of debt on it, yet it's kind of crickets. Nobody showed up.
Yep. So the GTCR acquisition, so WorldPay was sold at a loss. So if you look at so WorldPay, they bought that for, I think, about $34 billion in 2019, and they sold it at an enterprise value of $19 billion, and they sold like a majority market share. Right now, this is a business which has like $18 billion of debt on its balance sheet. Its credit rating is like BBB minus, so it's just like one rating below being downgraded high yield. And this is not a business where if you put more leverage on it, you can extract more juice by kind of either cutting a lot of costs or divesting a lot of arms which are very profitable. They made some acquisitions which are like small and they integrated it, but there's no like one golden goose which they could monetize to extract value. So just given the existing capital structure and the operating forecasts for this company, I don't think putting more debt and taking it private is going to be a good decision to juice IRRs.
You don't think they're underwriting, I guess, slowing growth or negative growth? Year 3, year 5?
So if you look at my base case, I'm forecasting like mid-single digit growth. And within the Merchant Solutions division, their e-commerce segment is actually growing at double-digit rates. So it's gaining like a greater % of market share. And like I was just reading a BCG report which said that in developed markets like the US, UK, Ireland, where they're one of the top 2-3 players, that transition from cash to digital payments is kind of like plateauing now. So that kind of gives me confidence that they can continue to maintain mid-single digit revenue growth rates. And if you look at my bridge, I'm not really forecasting a lot of growth because revenues are going to grow more than what they have historically. It's mostly because of the positioning they have in terms of how much cash they have and what they can do to deploy it if they don't make the mistakes that they have in the past.
Can I ask, you showed that I think operating margins are up 500 basis points in the last few years. Do you know what's driven that? And the context of the question is, if investors think it's a melting ice cube, and there's huge capital return and the margins hold up, I've found those are good stocks. But if something happens to the margins, then it kind of feeds the melting ice cube story. And a good example of this was Best Buy a few years ago, which the margins held up. They did execute a turnaround, and it was a great stock, so it proved people wrong. But you're already starting. I just wonder where those 500 basis points of margins come from, because you're going to have to maintain those during the capital return.
So I want to make 2 points here. One is these are the adjusted operating margins as reported by management, and they have a meaningful amount of add backs because of the acquisitions that they've made that they added back. If you look at my base case, I'm actually forecasting a slight compression in margins. So, but to your point, the reason that margins held up, the reason that margins held up is that since 2019, after acquiring TSYS, there has been a documented effort to moving the business towards the cloud. This has been a company which has been, this is a legacy operator. It's been running for like 30 years. There are a lot of like clunky old infrastructure, which they're currently working to overhaul. That's part of the reason. And the second reason is that as the business, especially merchant solutions, which contributes 75% to revenues, as the e-commerce part of that becomes a greater slice of the pie, the margin contribution from that also flows through, and the overall mix leads to the margin profile that you saw here.
Great. Thank you very much.
Good evening. Excited to bring us home. My name's Kit. Thank you very much for this opportunity. Really appreciate the chance to pitch Ibotta to y'all. So it's a little bit of a different story from these other names. They actually went public in early 2024, had a successful IPO, but we saw a 50% drawdown in the quarters following, mostly because of management, while delivering on the upper end of guidance, wasn't able to do the beat and raise that was really being expected of it. In the last quarter and the months following, we see kind of a stagnation across the price and the multiple, largely due to conservative guidance around the fourth quarter, paired with some really exciting new partnerships and things coming in that I believe the market just hasn't figured out how to properly price. So ultimately hinging on growth opportunities that I don't believe is reflected in the stock today. So Ibotta is a digital couponing app. So they are a company. They pair CPG brands with retailers to provide cashback deals to consumers. So my first thesis point is around the TAM of Ibotta, which is currently underpenetrated and I believe still growing as well as far as their ability to capture spend by these CPG companies. The next is around their retail partner flywheel, the ability to get the cashback offers to more consumers in that area, as well as their attractive margin profile, which I believe is defensible through their competitive advantage and will bring earnings to the bottom line. And ultimately, I'm pitching a 2028 price target that is $185, an IRR of 21%. So, as I mentioned, a digital couponing company. Not sure how many people in this room have clipped a coupon recently, but about 90% of consumers in the US have coupon in the past and around 60% do today, and that is moving more and more over to the digital space. So what Ibotta does, they serve as the network between these CPG brands that are offering cash back on their branded products. These are non-discretionary, high-frequency purchases, bringing them to consumers through various retail channels. So what is happening here is a nice flywheel on each side of this network. So the CPG brands are able, through Ibotta, to access more consumers day to day, get their products to more, get their offers to more consumers to be redeemed, as well as the retailers who are able to get drive more purchases, larger basket sizes, have more people come to them, especially as I'll discuss in my investment thesis going forward. And ultimately, Ibotta acts as kind of an air traffic control as well as clearinghouse, making sure that all of the offers are going to the highest return place. So how does Ibotta make money? Ultimately, they're a fee-based pay-per-performance provider, so they make money when they invoice cashback offers that have been redeemed. So we have third-party redemption revenue and direct-to-consumer. Let's say we buy a $5.30 box of cereal. Ibotta with a $1.30 cashback offer attached to it that is redeemed by the consumer. So Ibotta would invoice $2.10 to the brand, collect a 80-cent fee on that. They also have a smaller segment around advertising, but 83% of the revenue is in this redemptions. So we can see revenue has been growing quite impressively over the last just 2 years. We can also see in this first chart a shift in the segments. So what is really becoming more and more apparent is the future of Ibotta, and is really the root of the growth story, is this third-party redemption revenue. So as opposed to the direct-to-consumer or Ibotta's first-party app, these are offers that are being published by Walmart or other grocery chains. So now getting to the first point around the TAM opportunity with getting more offers from these consumer brands. So the first is around grocery spend. You can use the Ibotta app when you buy things in person, but the easiest way to interface with it is, of course, the digital version. So buying groceries online, grocery spend is huge in the US, but only about 13% of these transactions are online today. This is a large increase from where we were pre-COVID, which of course caused a bump up in that, but we continue to see this trajectory of increase going forward. The more people buying their groceries online, the more that they'll be able to easily see and use these cashback offers. The next is around CPG as a client. So CPG companies spend a massive amount on marketing, really high compared to other industries. So what's interesting about often promotions are included in the cost of goods sold for these CPG companies as far as their kind of in-grocery store promotion sorts of things. So even what we see in kind of their sales and marketing budget here is a massive amount that's spent on far less efficient methods than Ibotta. So they're spending on impressions, they're spending on clicks in search engines, as opposed to with Ibotta when they only pay when they've actually had a purchase come in. So the next is around the retail partners and how Ibotta is able to grow their users. So retail partners, I have their current partnerships listed here. They don't pay anything to have Ibotta. So Ibotta white labels their product. They bring all of the offers directly onto the platform. Why would third parties want to use this? Well, using the Walmart example, they have their own app. They have their own Walmart Cash. They're able to have these cashback offers in the form of Walmart Cash, which is a nice in their closed loop ecosystem, keeping customers captured within them. So Walmart is a key part of this story as well. They rolled out Ibotta to their Walmart Plus customers early in 2023, and then rolled it out to all Walmart users on the app, as well as you're able to use it in store. And immediately we saw redeemers double. So this was a huge step change in the redeemer base. Those are people who are claiming these cashback offers. This is something that we're going to continue to see growing forward. One, as more people are buying their groceries online using their Walmart app to claim offers, as well as bringing new partnerships in. One of the key updates that they announced in Q3 of 2024 was around a new partnership with Instacart, the online grocery delivery service. So going forward, all cashback offers on Instacart will be through Ibotta. As I showed earlier, not much change in the stock. So I'm going to be talking through what the market is missing on this. So Walmart is the largest grocery provider in terms of market share at 27% of the market, and Instacart is number 2. So 18% of online grocery sales go through Instacart. It's also great because it's typically a different customer than Walmart. We're thinking more urban, more tech savvy. So Walmart currently around 80% of the third-party provider redemption revenue. 90% of that is e-commerce. So valuing what is the total opportunity of Instacart at around 2/3 of that, just comparing their market share. So management did not provide much guidance. They were very careful to not give numbers around timing or what kind of the revenue build would be in. So the consensus estimates are shown below, but really very conservative, ultimately didn't move estimates from before and after the announcement too much. So I've applied to be a bit conservative, a ramp factor, showing ramping through 2025, so not rolling it out to all customers at once, going through 2025 and 2026, which would take much longer than even it was ramped out for Walmart. So, and then reducing what we see in the consensus numbers, ultimately this leads to a top line delta of 30% from what we're seeing currently baked in. So the Instacart deal is not showing up in the models today. They also, just a few weeks ago, announced DoorDash coming on as well. So really growing that online grocery service. And so finally, and briefly, just talking about the margins. So margins are something that have come up significantly, especially gross profit margin. We're really able to start to get leverage as far as their label and technology infrastructure. Operating expenses, also something that has been coming down nicely after an extreme period of investment, of course, in the tech infrastructure, R&D, and also the sales and marketing expense, which just a couple years ago was over 50% of sales, of course, attracting these CPG brands, which are now over 2,000, as well as getting onto the retailers. And going forward, as they, are able to bring in less high profile, it will not cost as much for them to bring those folks in. So have those kind of numbers coming nicely. But ultimately, this is really marginally different from consensus, no heroic assumptions, just to show that what I believe is a defensible moat will be able to sustain these, and the bulk of the delta that I have, which is in the top line, will flow through nicely. So finally, on the valuation, I have a 2029 earnings per share target of $7.60, applying a 21 times forward PE, which is about where it is today. Ultimately get to this price, as well as and applying the cash that is on the balance sheet. And I think that the multiple is fair. It accounts for, of course, the growth going forward, but also some of the issues with the stock as far as liquidity that I do see improving as well, though. So thank you very much.
What's the enterprise value?
So they're at 2.3 billion, and then their net cash. So
Okay, so that's the enterprise value.
yes, sir.
Okay, and so the revenue number is like 400 million in a couple of years?
I believe that 2024.
Okay, hold on. Let me see here. Net revenue is
So-
576 to 700. Okay.
Yeah.
Oh, do you have any international business?
No, currently it's all U.S. with a little bit in Canada.
Is there any reason why it won't work internationally?
No, there's no structural reason. It just is still smaller and growing.
Just kind of curious. Have you ever heard of Catalina Marketing?
No,
Yeah,
I haven't.
that's what this was 30 years ago. It's not gonna work? No. It's why I don't understand it.
So how old is the business?
So it was founded in 2011.
Do
Yeah.
you feel did you have enough data or frequency? Like, it seems pretty new, and then here comes Walmart, and what's that? What percent of their sales this year will be Walmart?
So of third party, it's 80%. So a very large chunk.
And is there a contract, or they've disclosed like the relation? I mean, sometimes that's a great thing, and sometimes that can turn into be a difficult thing.
So Walmart owns a stake in the company. I believe it's a little over 8% of the not the publicly traded, but they have a private ownership placement. So they were an early investor.
But is there any news, any 8K about the contract and the commitment? And
I'm not sure about that off the top.
yeah,
of my
I've
head.
owned GoodRx, and
Okay.
Kroger backed out on them, and the stock collapsed.
Okay.
Have you done any? What were your due diligence checks around? Like, is this going to be a household name in 5 years? Like, I'm just wondering if it's really going to scale like it could scale, or is it? I mean, why'd they miss out of the gate?
Why did they miss out? Oh, out of the gate.
Yeah.
So really it wasn't. So actually kind of what the biggest thing that's hamstringing the stock currently was around their Q3 of 2024 presentation, where they actually beat on guidance, but then they were a little bit more, they lowered their guidance for Q4 because some of that had pulled forward because of the annual nature of a lot of these CPG budgets. So they had kind of, ended up being stronger in Q3, but that means that they had a little bit less of the CPG budgets they were able to do in Q4. And I think that was a pretty big reason, as well as I think initially there was some excitement around the Ibotta app, like the D2C portion, as well as the ad and revenue portion, which is shrinking compared to the 3PP. And so I think that has caused some confusion as well. So ideally it would be less of a household name and more of the really kind of backbone infrastructure and the clearinghouse for all of these.
And white labeled by these retailers.
Exactly.
I mean, usually if you're growing that fast, you don't pull it forward 1 quarter after the IPO. But so Walmart and Instacart are 3PP.
Correct. Yes. So when I open my Walmart app, yes. So when I open my Walmart app, and I can go to kind of the Walmart Cash portion, I can also filter specifically by Walmart Cash eligible. So when I see kind of the button over there, I don't see anything to do with Ibotta, but that is the technology behind it, as well as really the biggest kind of argument against the disintermediation is what Ibotta's ability to work with all of the brands. Like they have that kind of relationship that manages the promotions that they are able to turn on and off, that also to make sure that coupons aren't being applied multiple times, multiple stores, that sort of thing. So the CPG brands are able to go through Ibotta to kind of disperse things, and the idea is, of course, that it would get smarter, more personalized. They're able to target people based on their purchasing patterns. I am being targeted for probiotic sodas, things like that.
The 80 cents on a dollar, was that just an example?
That was just an example, but that is actually pretty close to what it is. So
that's a lot. That's
or so not 80% of a
80 cents. No, you had the slide with the 80 cents.
Right. Yes. So the average kind of the average revenue to Ibotta per redemption was for third party is about 80 cents, coming down a little bit, and then for like if it's on their app, it's actually a little higher than that.
So I guess the 80 cent that was on a $5.30 item, so it's like 15% of the full price.
Yeah, that's.
Yeah.
It's a 40%. You get 25% discount, and then you got to pay another 15% to Ibotta. It's just interesting because it's kind of expensive, and I guess the limiting factor for growth right now is the brand budgets. I guess when I think about it, you've got revenue tripling, which I love. We have a growth stock here, but it's maybe not the retailers itself, which are limited on growth.
Absolutely, and that was that pull forward I was alluding to was they allocate a certain amount. So one comment from the CEO of General Mills saying like, oh yeah, we're seeing great work in couponing. We're actually going to be increasing our couponing budget by 20% next year. So they did talk about the supply and demand and not always being kind of a perfect up, but historically has always kind of been able to keep up, and they report a 7 times return on ad spend as far as their, the way that they kind of measure the success of the money spent by the CPG brands, as well as over a 96% retention.
Yeah. How does that work? Because I guess if you're going to spend 45%, 25% on a discount, 15% to Ibotta, we'll say, 40%. I mean, gross margins for some of these guys are 50%. So you're like a 10% gross margin. Their EBITDA margins are 15 or 20%. They're giving it all away to Ibotta.
Yes, and that sits in. They do sit in the gross margin for the It's hard to kind of parse out exactly, but the promotions do often sit up in that kind of larger chunk of 50%. I would say that yes, it is kind of expensive but compared to like when we talk about the other areas of the funnel, they have this cute graphic.
Parts of the funnel, like advertising, I guess, and other forms of couponing, I guess.
Right. So the massive amount that CPG brands are spending on marketing for these super, paper towels to drive these purchases with super price conscious consumers, and kind of a bloodbath is really kind of where they're trying to say that they can be the most impactful.
Why'd they, since IPO, why did they miss on the DTC growth? I think that was the bigger part of it, is now you got
absolutely.
growth of 3PP, which is 80% Walmart. That's less valuable than DTC.
Right, absolutely. So it is because with the national brands, they don't designate we want it to go necessarily to, it's all kind of the same pot of money that the DTC and the 3PP would be sharing. So what the management team emphasizes is that they're like, oh, it's actually great if, more money goes to third party than us, because we would rather have, more apps come, or more kind of retailers come on and people be spending more of the money that way. It's slightly lower revenue per redemption, but they don't have to pay to acquire the customer, that sort of thing. Yeah.
I'm a little remedial on this one because I don't quite understand it. But coupons are issued by all sorts of retailers and the CPG companies themselves. If this is indeed the backbone for CPG companies, is there another backbone for retailers? Is that different? Do they use the same backbone? Is it somehow meshed? And who are the main competitors, and what advantages does this company have over other competitors?
Yeah, absolutely. So actually, on the first part of your question, do you mean like if I buy a T-shirt from Walmart, is that still Ibotta?
If you just Google grocery coupons,
Yeah.
you get 2 pages of all sorts of providers. Safeway, you get Kroger, and
Yeah.
and then you get the CPG companies themselves who issue coupons directly. So if this is the backbone for the CPG companies, who's doing the backbone for retailers, or these guys doing that? And then within that context, who are the major competitors and what advantages does this company?
Yeah, absolutely. So as far for the retail portion of the question, so a lot of, retailers, they would like manage this kind of directly themselves, like with the CPG brand of having the coupons. And that was how, Walmart and Instacart, et cetera, like did it before. And the idea is that, much more efficient from their perspective to not have, a team managing like promotions for every single thing that they sell when they should be changing super often. And the CPG brands would rather be more, flexible on those sorts of things. When I go onto my Ibotta app, I can choose what retailer I want it to come from. So I was able to use, like the Whole Foods isn't necessarily a partner of Ibotta, but I can use my Ibotta coupons at Whole Foods. So hopefully that answers part of your question. And then on the competitor piece, so some of the other kind of big couponing players, and the one I hear about the most is definitely like Rakuten and Honey. Part of what's different about them is that their client is the retailer. So they kind of pay to make purchases, but by getting them to the site. And so as opposed to be paid for by the retailer, Ibotta is paid for, of course, by the brands that's issuing them. That is stickier in the sense that Ibotta now is kind of the network or the air traffic control that sits over all of it and is able to help kind of disperse. And what they also promise to them is kind of this return of the like receipt data and being able to have access to the other purchases going on at the retailers that they're working with. Ibotta does. Yes, and I did double check that for like with Walmart and stuff. With Walmart.
What does Amazon use?
So Amazon, I believe, does it themselves. Yeah, but they have discussed why there's no reason structurally that they couldn't be Amazon's provider.
I guess I would be more aware of the risk side of match rates or why they themselves.
But they just made the decision to move away from in-house to go onto Ibotta. Yes.
Why would, if their cut on this is 80 cents on a $2.10 wholesale, why don't the CPGs just basically give richer coupons directly? So instead of a $1.30 coupon, you have like maybe a $1.80 or $2 coupon. They still keep a little bit more. It's better for them, better for the customers. It just seems like that's just a more efficient system.
So as far as the CPG company like going directly to the retailer and just offering for what they're paying the same. Yeah, absolutely. So yeah, that is ideally to speak back to kind of what Ibotta is able to offer them in terms of a like performance network where they say like, this is the amount that we want to spend on coupons for the year. Please go forth. And Ibotta is theoretically able to be smarter with directing those coupons, turning them on and off, making sure that the right people are getting them and that there is not like a duplicate, like people trying to claim the same coupon at different locations that aren't talking to each other. Ibotta kind of serves as the clearinghouse for that.
Couldn't the CPG companies do that too? It doesn't seem like that's like, I couldn't do it, but it doesn't seem like it's rocket science.
I mean, with the retailers that are not yet on Ibotta, they are doing it with them currently. I think the idea is that there is the fact that 2,400 brands do work with them, the value add is certainly proving out in the growth, that they're able to drive more kind of redeemers.
They own the data.
Yes.
How long has this company been in existence?
So 2011 is when they started. Yeah, but from a very like the founder and his CEO as well, it was kind of very
What is their background? The founder and the CEO.
So he actually came from a law background. It's kind of a cutesy story that he was observing a colleague doing expense reports and was like, oh, what treasure trove is on the data of a receipt, and how great would that be to be able to kind of find some way to use that to help people direct promotions.
And did you do any due diligence calls with like brand managers, or just like, this works, this is the gold standard, we're going to allocate more money to this? Do you have any of that type of due diligence?
So the only the CEO of General Mills discussing there, and I bought a client discussing wanting to increase their couponing, and that was on their most recent earnings call. That's the only thing I have specifically from
Those are all from General Mills?
just the first one.
The first
The
one.
rest are from I believe, management.
They refer publicly to Ibotta?
Former management.
No, they do not.
All right, fantastic.
All right. Thank you so much.
Choosing the winner, it was very, very difficult.
The Pope's easier.
The Pope is easier. And so there are two. There's a second place winner that wins a cash prize of $5,000. Don't spend it all in one place. In fact, you should buy the stock that you pitched. And the first place winner wins $10,000. So the runner-up is Mario, who pitched CNH. Give a round of applause for Mario. Nice work, Mario.
Pictures.
Yeah. Congratulations, Mario. Congratulations.
Nicely done.
Yes. Do you want to say anything to the Academy?
Yeah. I guess I want to thank the whole Halburn Center. I want to thank my AVI professors, Mark Cooper and Jonathan Luft. Really influential in my value investing journey. Mark is actually the one who suggested CNH. And yeah, thank you to Meredith Julia for coordinating this amazing event, to all the judges. And I know you have CNH as well. So, thank you for the questions.
Okay. All right. The fix was not in, by the way.
Wait. He owns it and you came in second. Keep that in mind.
It's a danger of pitching a stock a judge owns. Okay, and the first place winner is Morgan, who pitched A.O. Smith. Woo! All right, Morgan, congratulations. Job well done. Morgan, do you want to say anything?
Yeah.
Look at the camera.
Yeah, I do want to thank you, the judges, for recognizing this. It's a huge pleasure, and thank you, Professor, for helping me to improve my pitch. It's definitely a very important part. And do want to thank.
Wait, I'm sorry. What was that?
I do want you to sign Pitch the Perfect Investment book. Yeah, it's like the learning material I read before I got into Columbia.
She's the only student who wanted 2 sessions with me. I'm just saying.
And you didn't tell us that.
I didn't say. I kept it completely silent.
Yeah, and really thank you, Meredith and Julia, for making this happen. It's a huge pleasure to be here, and it's a privilege. And thank you so much for organizing the whole value investing program and everything. Yeah, and yeah, thank you so much. And also the classmates, thank you for coming to support, and alums. Yeah.
Job well done.